Hey, folks, this is Randall Neighbor with Kingdom Wealth Management coming to you today to talk about something really important. I've had a couple of clients and a couple of friends ask me about reverse mortgages, and the attitude about them and the interest in them is all over the place from soup to nuts. And I thought the best thing I could do would be to find myself an expert and pick their brain for you. So if you've ever thought about getting a reverse mortgage or a friend got a reverse mortgage and you want to know more about it and you have a positive or negative view about them, then I want to introduce you to my friend. We've known each other for 5, 6 years now, and we go to church together. And this is Mike McFarland, or Mortgage Mike. And we both work in the Houston area, serving people all over Texas, probably. Mike, you work with people all over the state, right? And I'm going to pose 10 questions to him that I think are burning on your mind about reverse mortgages. And they're in my mind, too, because as a comprehensive financial planner, I quite often look at people's entire financial situation. And the folks that haven't saved enough for retirement, I say, man, you're sitting on a little gold mine in your home, but is this right for you or not? So I've educated myself. It's time for Mike to keep educating me and educate you too. So here we go, Mike. First off, tell us a little bit about yourself, what you do, how long you've been doing this, etc.
Yeah. So I'm Mike McFarland. I've been in the mortgage industry for, over 30 years. So right out of college, I stumbled into this business. The last pretty much 15 plus years of it, I've been an originator. So I've been doing forward mortgages predominantly. A couple of years ago, I just got curious around this concept of reverse mortgages and what they do. I think there's a bit of a negative connotation in the marketplace across the board, whether that's consumers, even in my industry, and probably in your industry as well, Randall, around this product. But I started to read from the financial planner point of view, specifically the retirement income planning specialist. I read a book by Wade Fowle. It really opened my eyes in regards to one, the problem that we have today in America with retired people and not having potentially enough money to have a decent lifestyle. And then what can we do with the reverse mortgage to supplement income or to help support lifestyle? And it does a lot of things. But in the last several years, I've really begun to make reverse mortgages a bigger focus of my business. And I can see the difference that it makes in the lives of the clients that I get to serve. So I look at it as it's really a lifeline that probably everybody needs to at least consider, and most people should do. So.
Very good. Now, not to put you on the spot, but I'm very familiar with Wade Fowle. And he is an amazing economist and financial planning teacher. He taught courses that I've taken. And I have mad respect for Wade Fowle. I'd like to meet that man one day and give him a hug, because I don't think he'd like me enough to let me hug him. So maybe just a handshake. But he has taught me so much. Do you remember the name of the book that you read?
Oh, yeah. Let me get it right here.
Oh, you've got it on tap. Okay.
I got it right here. It's the Guide to that might be backwards. I don't know, but it's Guide to Reverse Mortgages.
Guide to Reverse Mortgages. Okay, it can get easier to search for than that, huh?
Right. Yeah. This is it. So, and and then help me understand the product from your point of view. Right. It was really important for me to know. All right, as I'm working with clients, senior clients, it's like I need to know what their financial planners are saying or what they're thinking. I need to be able to speak the language across both sectors. Amazing book.
Yeah, really and when I was taking courses for one of my professional designations, he taught about a 3-hour class on reverse mortgages. And I'm really glad to see he came out with a book. Now I'll have to go buy the book and review it again, what I learned in class. I still have my notes. They're just somewhere, right? Anyway, all right, let's get started. Let's get started here, Mike, because I'm excited to find out. The very first question I have for you is, what is a reverse mortgage and how does it differ from a traditional mortgage, or what you call a forward mortgage?
Yes, right. So in the traditional sense of buying a home, you get a forward mortgage, you make a mortgage payment every month, right? So you're paying off a mortgage balance that you owed. On the reverse mortgage side of the equation, kind of think of it as backwards. What's going to happen is you're either going to borrow money well, you're borrowing money one way or the other on your home, but you're not making a mortgage payment. So what ends up happening is instead of paying down a balance like you would on a traditional purchase transaction forward mortgage, you end up borrowing money and then you don't get to make a mortgage payment. And that then mortgage balance grows over time, right? So it's a great way for people that are retired to create additional, for lack of a better word, I guess, an income stream, right? Because we don't have a mortgage payment, which then allows them to dedicate that money to other things, right? Whether or not that's debt service or living or whatever. So on the forward mortgage side, if you take the money out, you get to pay it back. On the reverse mortgage side, you don't have to pay it back until something happens that causes that note to come due or payable.
Okay, and we'll talk about that in a minute.
Yeah.
Now they can't call that loan on you if you meet the requirements. You still live in your house, you're keeping it up, you're paying taxes and insurance on it. They won't call that loan on you no matter how much it is. Is that right?
Yeah. Correct. I would say that there's one instance where they will, and that's if you're outside of the home, if you're not living in the home for a period longer than 12 months. So for some reason, we end up in long-term care, and that would be for both borrowers. So if we have two people that are married and one ends up in long-term care and the other one's still living in the home, nothing happens. But the moment the house has been empty for longer than 12 months because neither of the borrowers can live in the house, at that point, then the process of calling the note due kicks in. So,
gotcha. Okay. All right. Number 2, why do some people think reverse mortgages are bad and should be avoided?
Yeah. So I would say a lot of that has to do with past negative experiences. So when this mortgage was created, it was created like back in the 80s. And it didn't have it was a forward-thinking product, but it didn't have a lot of consumer protections around it. So over the course of the last, gosh, how many years has this been going now? 50, 40 years, something like that. It's an FHA loan. So FHA and HUD have been refining the mortgage product to give consumer protections to it. So absolutely, I'd say that if you go backwards in time, there's a lot of horror stories around, oh, reverse mortgage was the worst thing that ever happened to my parents, typically is what it is. You hear from kids. But that's been refined over time. So I think all of the myths around reverse mortgages that we hear, honestly, are just myths. I can dispel them as I start to talk people to them and let them know, hey, well, we probably are going to talk about those myths in a minute. But there's just this negative connotation that really FHA has put safeguards around for the consumer, and that they don't exist anymore, but we have to overcome those. They're initial objections, but once we begin to talk about them, everybody feels like, oh, okay, it's actually a safe product for me, and more importantly, my heirs is what they're thinking about. So,
gotcha. So to summarize, would it be safe to say this is not your father or your grandfather's reverse mortgage anymore?
Correct. Exactly.
Okay.
Yeah.
All right.
Yeah. No, if there's one that started in 2000, it's finally coming into some end existence. It may have those old rules attached to it, but they started to really make changes in about 12 to the guidelines around the product, and we're seeing it refined and refined and refined. That in today's world, anything that's produced now, in my opinion, is a safe product for our clients to get into.
Okay. All right. Can you briefly explain how a reverse mortgage works and what they cost?
Yes. So from a reverse mortgage standpoint, let's say that the house, it's built around the value of the home and the age of the youngest borrower, right? So we don't take the oldest borrower, we have to take the youngest borrower. So let's say, for example, I'm going to use simple numbers because I have to think simply in my own brain. Let's say a house is worth $100,000 and there's no mortgage on it. Let's just start with the fact, okay, we have no mortgage on it. So we have a $100,000 value in home. We have a client, it's a calculation that I had to put into a calculator. So I'm going to say, let's say the clients are 72 years of age. They're probably going to get their hands on about 50% of the equity in that house. So if the house is worth $100,000, they probably have $50,000 in equity that they can use for the reverse mortgage. So that's
half of the appraised value of a home.
Exactly. And it could be more, the older the client gets, the more equity that's available uh,
Huh.
to for the borrower to get hold of, right? So the younger they are, the smaller amount. But if I'm dealing with somebody in their 80s, 90s, all of a sudden we might be doing 60, 65, 70%.
And I'm
Um,
assuming that's because their lifespan and getting out of that
bingo.
house is going to happen sooner than later. So
You
yeah,
got
all
it.
right, very good.
This is
Okay,
clearly if you really look at the product, it's an insurance product, right? It's an FHA
it
loan. It's
it is
mortgage
working like an
insurance
insurance
attached to it.
policy. You bet. Yeah.
Yeah,
Yeah.
they
Okay.
run these actuaries, and they think the house is going to continue to improve in value. The mortgage balance kind of goes like this, and they're always going to have an equity cushion in it. So,
Okay.
and for
All right.
some reason there's a catastrophic loss, we have insurance that kicks in and protects it. So that's the basics of it. It's a little bit more complicated than that, but that's the simplicity of looking at it. When we start looking at cost, I will say that probably the biggest objection, although I don't think it's a real objection, but it's one that we have to talk about, is well, it's expensive. It's probably about $20,000
Okay.
on average. And the biggest chunk of that expense is what's called the mortgage insurance premium on an FHA loan. And that usually runs like 2% of the balance. So that's the biggest chunk of the cost. So when we look at the 20 grand, usually about 10 grand of that is MIP or mortgage insurance premium.
Now,
The rest of it's either,
for previous conversations, you told us there's two ways to pay that. I can write you a
yeah,
check for 20 grand,
right.
or what's
Or
the other way?
we just build it into the loan balance. So
So
for
if you're
example,
so yeah, go give me an example.
yeah. So that $50,000 equity that's available on that $100,000 valued home, this is probably not the best example to use, but we'll say 20,000 of that becomes cost, and now there's 30,000 in a line of credit, lump sum distribution, or a tenured option that the borrower can take.
Yeah, now, we might have we might get into the weeds on this and deeper in, but reverse mortgages aren't just one big payment or a little tiny payment for the rest of your life or whatever. There's a lot of different ways you can take your reverse mortgage amount.
Absolutely. Yeah.
Almost
Yeah.
like an insurance company with annuity options.
For sure.
Yeah,
For
yeah.
sure.
So I want 10 years worth of payments, period
Yeah.
certain. I want a lump sum. I just want a
Yeah.
line of credit. If I don't use it,
Yeah.
it sits there and grows as the value of
Right.
the house grows and grows. Okay, cool. All right. So
Correct.
there's a lot of different options. We won't get into the weeds on that one. But okay. Number 4, who would benefit from a reverse mortgage the most?
Everybody. So if reading through Wade Fowle's book, Wade Fowle is going to say you should get a reverse mortgage line of credit the moment you turn 62. Now the math has to make sense.
Yes.
Everything's got to line up on my standpoint, so that I'm saying, yeah, we've got the equity there. Let's make it happen. So I would say that anybody that's over the age of 62, because that's the minimum age for a reverse mortgage, should at least start thinking about how can we implement this in their retirement income planning strategy. It may not be at that moment at 62, and it might very well be that moment at 62. But I think it's a good counterbalance to what you need for your clients on the financial planning side of the equation, just so we know how to leverage it. So I would just say everybody's a candidate for it. It doesn't mean that everybody needs it or is in a position where we can actually tap into it at that moment, if that makes sense.
Okay. So here's another question. This is not part of the 10, but do you have to have a
All
really
right.
good credit score to get a reverse mortgage?
Not really. This is not it's halfway a credit driven product. So when we think about the differences between a forward mortgage and a reverse mortgage, forward mortgages are heavy underwriting. I'm looking at credit and it's got to be in really good shape. I'm looking at income and I got to be able to document that income with I's dotted and T's crossed. We go through a tremendous amount of scrutiny in a loan file on the forward side. On the reverse mortgage side, really, it's a very light underwriting touch. The only thing we're looking for is, okay, is the borrower able to make their property taxes payments at the end of the year and their homeowner's insurance? Can they maintain their property? And then, so how do we do that? Well, we're looking at income sources, Social Security typically, right? They probably have some distributions off an IRA. maybe a pension. And then the other thing we look at, we do pull credit in, but it's not FICO score driven at all. It's just to make sure that they can pay their bills. Like, do they pay their bills, right? That's all they're looking for when we start looking at a credit report. So
Okay.
unless
Very
your
good.
credit is just tanked and terrible, you're probably not going to have a problem. So
Okay. So is there somebody who just should not seek a reverse mortgage? I can think of one thing, but you're the
uh,
expert. You tell me what it.
you know, I mean, I think I go back to Wade Fowl on this, and I would say I think everybody should, even when you think you don't need it. If we've got the ability to tap into the line of credit on home, so the most popular mortgage option is what's called a line of credit. And that line of credit grows every year, right? So let's say we institute a $100,000 line of credit. That line of credit's going to grow 6.5, 6 5/8 in today's market every year. So 6.5 to 6.625% every year line of credit growth, right? It's just growing. So basically over a 10-year period, that $100,000 turns into 200,
Gotcha.
right?
Gotcha.
So we've got this line of credit. Let's say we don't touch it and it just continues to grow over a 10-year period. And then let's say maybe there's a catastrophic health event that requires a $50,000 bill, right? And so they could come to you and Randall, and they're like, hey, I need 50 grand. You're gonna have to liquidate this out of my account. Well, what kind of penalties are they faced with at that point in time? Right? We're gonna pay taxes on it.
Yeah, at a minimum taxes, you're right.
At a minimum, right? All of a sudden, we take that and add it to their income taxes because it's distribution. Uh-oh, maybe we just blew out their tax bracket that they're in. That's a potential problem. Or we could go to that line of credit and go grab that $50,000. It's not income. It's not reported on a tax return. And we just grab that whole 50 grand and we just go pay that bill.
Now, extra question here. You're opening up a can of worms for me.
Yeah.
If I wanted to retain my whole line of credit, could I pay that back over time?
100%. If you want to pay it back, pay it back. If you don't have to pay it back.
And if I don't pay it back, it just accrues interest.
Just accrues interest.
And when the house sells for whatever reason, they get paid theirs. The leftovers, I get the money, or my kids get the money if I left it to them, and I'm gone.
Yeah.
Okay.
Yeah.
Right.
The mechanism on sale is no different than a normal sale transaction.
Yeah.
We're paying off a lien, whatever that lien balance is, gets paid off. Whatever is left or proceeds to the client or the heirs.
Now, if somebody came to you flat broke,
yeah,
and they were barely able to pay their property taxes or had deferred the property taxes. Some people don't know, in Texas anyway, you can defer your property taxes
right.
With a 5% simple interest loan, and they can't afford a roof and they need to borrow money on a reverse mortgage.
Great product. It's a great product.
Great product. Yeah. But the reverse mortgage company requires them to upkeep the house, pay the insurance on it, and keep the taxes done. So they might not qualify for one if they can't prove that they can do those things, right?
Well, this is where we kind of now underwriting kicks in, right? So this is where underwriting is going to say, okay, first off, how much equity is available to borrow? Let's say that house is owned free and clear. It's a $300,000 home. There's a ton of equity. But we have a client that doesn't have a lot of income coming in. Well, that equity is an income stream. And so we can turn that line of credit into an income stream to help qualify. So we're not just qualifying on Social Security alone. We're like, oh, well, wait, we got this line of credit. We can impute that into a cash flow, and that can help qualify them. The second thing you do is you can set up what are called leases. I'm going to totally get this right. Life expectancy set aside. Basically, we can set up the reverse mortgage to pay the taxes for them.
Okay.
So that's another option. I don't like that one because it's pretty heavy in the way it drags down the line of credit. It's not preferred in my opinion, but if it's necessary, it's there. And for some people, that just needs to be that, right? Let the mortgage pay for the property taxes so you can age in place. Like the last thing we need to do is start moving somebody in their late 80s, right? How hard is that to do? We want them to stay, be comfortable, live where they live as long as they possibly can. So that Lisa, that life expectancy set aside, can help with that equation. There's another part to that question you're asking me, Randall. I'm totally drawing a blank on that. We're going
No,
down
it's all
that
right. It did bring up another question. So it would
yeah,
seem to me, though, coming from my comprehensive financial planner, always thinking about you 20 years from now or whatever. Yeah. Hey, Randall, I got a reverse mortgage line of credit. I got $75,000 after the closing costs and everything. And I just wanted to let you know I bought a motorhome with it, paid cash with
yeah,
it. And we're going to tour the United States.
yeah,
And I'm like, really? You took all of the line of credit out and you're struggling financially. How are you
yeah,
going to pay for stuff when you're driving around the country, incurring more costs with fuel and everything else, and insurance and storage on that RV, et cetera? So it would seem like this is something that you need to talk with other people about
yes, for sure.
before you do it, not just before you apply, but before you do something with it, and to be
100%.
wise,
Yeah,
with it. Yeah. So,
I think
okay.
really it's best executed in the environment of me and you as the financial planner in the mix, right?
Yeah.
So it's our client, you're the expert on, hey, what do you do with this money now that we gave it to you, right? I know how to get it, but I can't control their spending. I mean, it's they want to spend it, they can grab hold of it and spend it, right?
Yeah.
So they need good counsel as they kind of hit the lottery of the equity in their home, that they spend it wisely, right? Like probably taking that entire distribution and going buy a motorhome may not be the best option.
Right.
But then again, maybe they have a ton of money in investment accounts with you, and this is a great, easy way, cheap
There you
way
go.
for them to go do that. And then maybe in that instance, I'd say, well, go for it. But they would be talking to you first to make sure it's
Yeah.
not messing up
Yeah.
the other strategy you have in play for them.
Yeah. Yeah. I
Yeah,
constantly tell my brand new clients, I don't tell you how to use your money. I'm not your dad. I just tell you what the effects of using your money the way that you're telling me you want to use your money will have on your future, so that you
right.
can have a very frank conversation with old version of you to see if that was a good idea or a bad idea. Because old version of
Exactly.
you will not care about how you feel today at all, or what you didn't
Correct.
get to do, or what you did or didn't look like in front of your friends and neighbors based on
Yeah.
what you were driving or whatever, right?
Correct.
Old version of
Correct.
you just wants the medicines they need, and they want to be able to give the grandkids a little extra money for college or take them to Disney or something. Anyway, all right. Okay. Number 7, we talked a little bit about, but I thought I'd hit it again. If I have a reverse mortgage and I move into a senior living place or rent my home and I don't live there for, what did you say, a year? What happens?
Yeah. If you rent your home, that note's coming due and payable. Right. At that point, you're gonna make the deed of trust kick in because you've turned that into a rental property.
Now,
It's
what
no
happens if I
longer
rent a room in my house?
if you rent a room in your house, you'll probably be fine as long. I would say you're okay there as long as you still maintain that as your primary residence, right?
Okay.
But the
All right.
moment you shift out of that being your primary residence, we got a problem. Um, the other thing would be you're in assisted living or you're out of the home for longer than 12 months, right? For whatever reason, you're no longer in that house for over a 12-month period. Then at that point, the deed of trust is going to kick in and cause
Okay.
the note.
Okay. So if you move out of the house and you're gone for 12 months, they'll call the loan.
They're going to call the loan at that point. Yeah.
If both of the lien holders die,
Yeah.
they're going to call
If,
the loan.
yeah. Yeah. One
And
dies,
then
the
your
other lives for
children,
another
for
15
instance, or your
years.
heirs have how
Yeah.
long to sell the house and pay off that loan?
12 months. So
They
there's a
have a
year
year.
period.
They have a
Yeah.
year
They
to
got a
clean
year.
it out, clean it
Yeah.
up, get it on the market, and get rid of it.
Yes.
Okay.
Yeah.
All right. Good.
Well,
Okay.
they got three things they can do with it. They can sell it, right? They can refinance the principal balance. So if they want to keep the home, which is some people may want to keep the home, then they can refinance whatever balance of the mortgage is left at 95% of the balance of the mortgage. And that's it, right? They could just refinance it and take the property in their own name and pay that portion of the mortgage off. Or let's just say let's say the market tanked, housing prices are suppressed, house is in terrible shape, they owe $300,000 and the home's only worth 100, then the heirs can just say, okay, we're just going to give you the keys, deed in lieu of foreclosure. Here they are. You take over the property, HUD. We don't want it. And then
All right.
foreclosure will happen. Nobody's on the hook for anything. The estate doesn't owe any money back. It's just like take the property and how'd you sell it?
All right. Okay. We've got 8 minutes left, Mike. So
Okay.
we're going to have to
Okay.
get through these next
Go
three.
fast.
Get next three fast because I'll probably have some secondary questions. Hopefully, no tertiary questions for you. If I leave my home to my kids and there's a reverse mortgage on it, what happens?
Sell it or refinance. So they're going to get the property, but they got to sell it or they got to refinance the balance of the mortgage, one or the other.
Okay. All right. Okay. So should someone work with a financial planner before getting a reverse mortgage? Here's a softball question for me.
Yes, 100%. Right. I mean, I go back to earlier. It's the best way to do this is when you and I, financial planner, loan officer, client, are all just talking about, okay, what are we doing here? What do we want to accomplish, so that we get the best mortgage solution in play, and also it fits with the retirement income plan that you have for them. So 100%. They need to be working this in concert with their financial person.
Okay. So, last question I've got for you is me personal. This is me talking to my friend Mike, folks, about my thought for my family. All right. I hope to build my next home in the Tennessee mountains and retire there. And Lord willing, I'll get tons of money out of my paid off home in the Houston Heights, which is skyrocketed in value. I'll pay cash for that one. And my plan is to as soon as I get that thing finished, and I'm living in it, I'm getting a reverse mortgage for every dollar I can get. And here's my thought. And I don't need the money for income flooring or planning or whatever. I got a nice security check coming, but I'm not counting on it. I've got annuities that I'm not counting on, but I've got savings and I've got other stuff. I'm not worried about my income stream. I'm doing this personally just because I think, and you tell me if I'm wrong, Mike, but I think that one day I'm going to be 80 and I'm going to want to do something that's pretty expensive.
Yeah.
And if I go to a bank and say, hi, I'm an 80-year-old guy and here's my fixed income. This is what I get from my annuities. This is what I get from my dividends. This is what I get from Social Security. Loan me $250,000. They're just going to go, no, I'm sorry, sir.
You don't make enough money.
You do not have enough income for a $250,000 loan. We will not give you a personal loan. We will not give you a home equity loan.
Yeah.
And then I don't know, would I qualify for a reverse mortgage then? I don't know. But that's my thought. Yeah. And so I get it I get it after I get into the house and I get my line of credit. I don't touch it, let it grow. That's 6.5%, 7%. Let it double every 10 years. And for the off chance that I do need the money. And hey, if I don't need the money and I'm 80, how about I take out a big chunk of it? Since we don't have kids, then I'm not worried about leaving a home for my children. I take my wife on a round the world first class cruise. And
absolutely 100%. You can do that. You can do that for sure.
Okay. All right. Yeah. So I have a few minutes left here. So is there anything else about reverse mortgages that people should research before pursuing one, aside from talking to Mortgage Mike and Randall Neighbor?
Yeah, I mean, I really think it's reaching out to us. There's just a lot of junk on the internet. So, I mean, you can read yourself silly, which most people do by the time they reach out to me, or you probably on them. But the truth of the matter is, if you think you're interested in it, reach out to a professional. Let us understand your circumstances, and we can guide you to the best possible solution. There's a lot of solutions out there. There's a lot of misinformation. And that misinformation can scare you from doing something that actually will help you, but that misinformation throws you off and you're like, oh, I don't want to do that. They're bad, and they're not. So I would just say, if you even just have the inkling that it's something you're interested in, reach out to a professional, reach out to Randall, reach out to me. Let's just talk about it. If it doesn't make sense, it doesn't make sense. It's okay. It's a free conversation,
Very good.
right?
Very good.
But if
All
it
right.
does, then we need to start it and we need to go. So,
All
uh,
right. Well,
yeah, go ahead.
Mike, thank you so much for taking the time to talk with me and all the people watching this. I'm sure thank you for a very frank conversation about it, what it's good for, what it's not good for, and how to use it, what to watch out for, and to seek wise counsel
Yeah,
before you do anything like this. But it could be a very, very helpful thing for almost anybody in retirement to have a reverse mortgage line of credit if in or a stream of income they can't outlive,
right. Exactly.
and to supplement what they've got from withdrawals from investment accounts or a pension or Social Security. So
Yeah.
very
Yeah.
good. All right,
Yeah.
folks. I'll put the information for Mortgage Mike here at the end of this, and put my information too. And I encourage you to talk to either of us about reverse mortgages, forward mortgages,
Yes.
and comprehensive financial planning. My practice is faith based, and we just believe all your money belongs to God, and we should invest it in ways that make Him smile. So, so our portfolios and our money management and our planning and our recommendations all come from a biblical perspective. So know that when you visit with us, and if your advisor is not doing that for you, or you don't have an advisor you're looking for, we'd love to help you with that. So, with that, we'll sign off. Thank you, and thank you, Mike.
Thank you, Rand.